Welcome to the Infrastructure Podcast. My name is Anthony Oliver, and today we take a close look at the investor's perspective on the UK's infrastructure market, and in particular, what the landmark final investment decision on the new Sizewell C nuclear power station tells us about the appetite, the risks, and the reward for long-term private capital. Because following completion of the deal last month, for the first time, the British public will be co-owners of a nuclear power station sitting alongside a powerful mix of investors, including EDF, Centrica, Caisse and Amber Infrastructure. And as such, I'm pleased to be joined today by Jamie Hossain, Senior Investment Director at Amber Infrastructure, who has been leading their latest 7.6% investment in Sizewell C. And I hope he will therefore be able to give us his first-hand perspective on the deal, what it means for UK infrastructure, and perhaps also what is in his future pipeline. A bit of background, Sizewell C is one of the most significant new energy projects in a generation, a 38 billion nuclear power station in Suffolk that will be a twin of the Hinkley Point C station now under construction in Somerset, a project that signals a new era for infrastructure investment in the UK. Some 70% of the construction spend is expected to flow to British businesses, with tens of thousands of jobs created. So it's a project that demonstrates how public and private capital can work hand in hand to deliver national benefit. But what does this mean from the investor's perspective? Well, let's find out. Jamie, welcome to the Infrastructure Podcast.
Thank you, Anthony. It's a pleasure to be speaking with you today.
Great. Well, it's good to see you. Let's get straight in and start with your recent investment in Sizewell C. So what attracted Amber Infrastructure to this project, and how does it fit within your broader investment strategy?
So Amber was attracted to the Sizewell C project really when the government started talking about the way it was thinking of funding it, and specifically funding it using a funding model called the Regulated Asset Base or RAB funding model.
Right, yeah.
And this RAB model is something we know really well. It's something we've invested in the past in the context of a greenfield construction project, the Thames Tideway sewer, which through our listed investment trust, INPP, have been an investor in since 2015. And back then we helped shape that particular investment with the RAB model. And it was shortly after the financial close of that particular investment that actually the government was thinking about how it could use the model to fund other large, complex infrastructure projects, including nuclear. And so we actually were having some initial dialogue and engagement with the government shortly after Tideway closed in 2015. So we've actually been associated with the Sizewell C project for quite some time, and therefore delighted to have achieved the final investment decision earlier this year.
Yeah, and certainly it's quite a milestone. But let's get a few definitions sorted, Jamie. You talk about the RAB model. I mean, in simple terms, it means linking bills very closely to the cost of that infrastructure asset. How would you describe the RAB model then?
So one of the really attractive features of the RAB model is that what it provides investors is very much a long-term predictable cash flows using the regulated asset base that is inflation linked, and importantly also mitigates some of those really challenging risks that low cost of capital infrastructure investors like our capital sources would otherwise struggle to price effectively. Because we're accessing bill payers early on during construction, and bill payers, it's estimated, will be paying about £1 per month on the typical household bill.
Yeah.
And what that does is that contributes to the project during the construction phase. And that's really crucial, because what that means is that the project is earning a revenue during the construction period, and that revenue is generating a return for investors, which they are able to benefit from. And what that then ultimately means is it attracts lower cost investors to investments of this nature. And because the financing costs for these very large, complex infrastructure projects tend to be a very large proportion of the overall cost, actually by lowering the financing cost, you deliver a better value for money model of delivery of an infrastructure asset.
Yeah. And certainly, as you say, it's a model which has successfully delivered the Tideway project in London. I mean, how significant is it therefore that UK households will effectively be co-investors in this project? I mean, does it mark a shift in, I suppose, what you might call public participation in infrastructure?
Yeah, I think it does. And I think it's for the benefit of all stakeholders. I suppose back in the early days or some time ago, a lot of regulated utilities were funded purely by the government.
Right, yeah.
And that brought its own challenges and arguably lower levels of service and inefficiencies. And then we had the privatization model from the 80s onwards. And, I think that brought a lot of benefits. But I think the way the model has evolved now by bringing both public and private capital together really aligns the interests of both to the same goal, and that can only be for the benefit of delivering the underlying project.
Yeah, because I suppose it's a point that Sir John Armitt, chair of the National Infrastructure Commission, always used to make. There's only two ways of paying for infrastructure. You either pay it through tax or you pay it through your bills, etc. And I suppose what the RAB model does is it's very explicit, isn't it? It gives everybody on all sides of the deal clarity about what's happening.
That's right. I think that's really important that these models from the outset set out the clear risk and return parameters. They create the right incentivizations and allow investors to price risk effectively. And that's risk that investors can price. And one of the real advantages as well of the RAB model is that whilst it's fair to say investors are certainly taking risk through the construction period, it is not unlimited. And as investors, we are committed to a certain commitment level, beyond which then we're not obliged to commit any further capital, and the government can choose to step in to finish the project.
Yeah. Well, and it's interesting you say that, because new nuclear in the UK is certainly not for the faint-hearted, Jamie. I mean, how do you evaluate risk and return in a nuclear project this scale and duration? Given the 38 billion cost, the 60-year operating life, and what goes before it at Hinkley Point, which hasn't been without its challenges. I mean, how do you evaluate that?
Yeah, so I think there's perhaps two lenses to look at this, and one of those is the what's known as the government support package, and the point I mentioned around investors only committed to a certain level is a really important part of that. So for us as lower risk infrastructure investors, we cannot be writing unlimited checks, and we take the substantial risk up to a certain point. The RAB model also provides other risk mitigation features important for lower risk infrastructure investors. So things like decommissioning liabilities, for example, it's not something we're taking on. So creating the right risk framework is really important. And that's why we see this very much as a regulated investment, despite the fact that the underlying investment is in the construction of a nuclear power plant with its construction. And I think maybe the second lens to highlight is the replication strategy that Sizewell is looking to adopt. And what I mean by replication is, you mentioned Hinkley Point C earlier. It is going through a lot of, shall we say, learning as it's going along. It's redeveloping the nuclear supply chain and manufacturing expertise in this country, because we've not built many nuclear power plants, and Hinkley Point is the first one in a generation. And what Sizewell will benefit from is replicating Hinkley Point's design, its supply chain, and the items of kit that are being manufactured. And it's worth saying that Sizewell is going to be as close to a carbon copy as Hinkley as possible. Over 80% of the above ground design is going to be the same. And as we all know, once you've done something once, it's certainly easier to do it a second time.
Yeah. No, well, the other way of looking at it, Jamie, is that continue to do the same thing and expecting a different result is a sign of madness. But clearly there is some assessment that's been going on about what is actually going to transpire at Sizewell C. So, but government being the largest shareholder, I mean, how does that public co-ownership really influence investor confidence and project governance? I mean, yes, it's got to be about providing confidence, policy confidence, etc. But is there more to it than that? I mean, you mentioned a lot of the issues around the limits of your liability. How would you describe that the benefits of having government on board in such a big way?
I think for such a nationally important infrastructure project like Sizewell, I think it really is helpful to have the government alongside. It, as you say, provides a strong signal of its commitment and policy alignment. And I think also by being an investor as well, alongside private sector capital, that really creates a strong alignment of interest between both public and private capital. So I think the government's involvement in that manner is really to the benefit of the project.
Yeah, because and that's important for you because you need to be sure that given what's happened at Hinkley Point in terms of cost escalation and time frame escalation, you need to be certain you're going to get your money back in the time frame that you expect.
Yes, I mean that is absolutely really key for being a low risk infrastructure investor, and we've spent a lot of time looking at that, and we take a lot of comfort from having been an investor in the RAB model before in Tideway, and we were really pleased that the government has chosen to use the RAB model for Sizewell, creating the same or very similar risk return parameters for investors, and that builds confidence in the infrastructure investment sector and creates a bit of a virtuous cycle, because that should in turn bring further private capital to support the funding of our country's infrastructure.
I mean, lots of really, really positive things that are happening there, but you're also looking at ongoing inflationary pressures, and just to bring you slightly down a bit, maybe, Jamie, sorry. But, you have got some inflationary pressures, rising capital costs, the costs of skills, etc., pressure on skills, etc. How do you ensure financial resilience over such a long construction period, and then I suppose a long operation period that goes on after that? What does the supply chain need to do to give you that confidence right now that it's not going to spiral out of control?
So I think this is, again, actually highlights one of the other benefits of the RAB model, and the way that it inherently inflation linkage is built in to the way the revenues are generated and the cash flows that the project company earns. And that creates a really strong hedge and a really important factor, as you rightly point out, for infrastructure investors like us, because we do not know what inflation will do in the future over such a long time period. And so having that built into the underlying regulated returns really mitigates that risk. And I think on top of that as well, it's worth highlighting that the supply chain are also very highly incentivized to deliver the project within the funding that they've set out. And a lot of work that the Sizewell C management team have done has been around ensuring the right incentives for the Works Alliances packages to ensure that strong alignment of interest.
Yeah. Well, let's hear a little bit more about Amber Infrastructure. I mean, the firm describes itself as a long-term responsible investor. How do you balance those really vital financial returns with the social and environmental outcomes that are necessary in your portfolio?
So our approach to sustainability recognises the interconnection between financial and non-financial factors. And we focus on issues that have the potential to influence returns, assessing environmental and social drivers as part of our evaluation, as part of our risk assessment, and indeed the way in which we select opportunities. So projects like Tideway demonstrate how a clear focus on material, environmental and social factors can deliver the expected returns as well as the environmental and social benefits. And we very much aim to do the same with Sizewell.
Yeah. So in the Tideway instance, you've got people in London paying for this asset through their bills, and in return they get a better river, and they also get a lot of infrastructure which gives them, I think, in the words of their the Tideway project, it re-engages that population with that asset. And I suppose what's interesting about nuclear power stations is that the people that live close to nuclear power stations generally are really engaged in their operation. Their supply chain and the local job creation is a vital bit of it. I mean, that presumably, that's where the similarities for you are between a project like Tideway and Sizewell.
That's right. I think Tideway did a really great job in terms of that local and community engagement, the economic benefits of the job creations, and Sizewell is no different. Sizewell, for example, is expected to create 10,000 jobs, 1,500 apprenticeships. And you mentioned earlier that 70% of Sizewell's content is expected to come from the UK. So it should benefit the country as a whole, but also in its more local sort of community around East Anglia, where Sizewell is engaging with the community, investing in local infrastructure like roads and rail, which will help the locals and the local community. And they're also doing things like investing and creating a new sixth form college, which is interesting because at the moment, young people close to where Sizewell is going to be built would have to travel quite some way if they want that level of education. So it's just one of many examples of the enhancements that the project is bringing to the local area.
Yeah, certainly that's something which Julia Pipe mentioned when I spoke to her on the podcast a couple of months ago. The power station doesn't sit there in isolation. It's part of an infrastructure ecosystem, a community that sits around it. So beyond Sizewell, Jamie, what other sectors or geographies are currently most attractive to Amber and why?
So I suppose worth saying that Amber is quite a broad infrastructure investor. So maybe just looking through the lens of INPP, its core infrastructure capital source. So INPP does tend to invest in lower risk, regulated and essential infrastructure assets, and we're seeing a lot of opportunities of that nature in the UK. INPP is about 70% invested in the UK, and that's partly because we do see a lot of attractive opportunities in things like transport, digital connectivity, and indeed energy transmission. INPP is actually a preferred bidder on the Moray West offshore transmission assets. So these transmission assets connect offshore wind farms, in this case the Moray West offshore wind farm, to the onshore national grid. And these types of investments create and provide the same kind of long-term contracted and inflation-linked cash flows that INPP very much seeks in its investments. Yeah. So we see a lot of opportunity in the UK using some of the models that we've talked about, RAB and offshore transmission. But also INPP is an investor overseas, and we have investments in Western Europe, the Nordics, Australia, New Zealand, and North America. And we're seeing equally similar opportunities in these very stable countries that match INPP's investment characteristics, that have the same kind of sectors in terms of energy transmission, transport, social infrastructure and digital infrastructure. So we see a lot of opportunity, and it's really about selecting the right one that delivers the best risk and return for our INPP's shareholders.
Yeah, and that also means, I suppose, making sure that those investments are aligned to communities that they serve. I mean, I spoke to Mark Gilligan of AXA Infrastructure Management a few weeks ago on the podcast, and he highlighted the huge opportunities and challenges as well around decarbonised energy. I mean, how is Amber adapting its investment approach to align with the UK's net zero and energy transition goals?
So it's something that we put a lot of focus on, really, to ensure that we are able to enable decarbonisation to work in practice, providing reliable baseload power, for example, through nuclear in the RAB model, providing more electricity networks, and I mentioned the offshore transmission a moment ago, and also thinking about things like grid stability solutions and efficiency upgrades to reduce demand. I think for us as well, at the portfolio level, we set credible and asset level decarbonisation plans, and we price those climate risks into our returns. So we very much focus on the reliable cash flows and clear policy support, but that in turn requires good thinking around how the decarbonisation strategy can work alongside that.
I mean, you also work with both public and private clients. I mean, what do you see as the key differences in managing expectations and accountability between those two types of client?
Yes. So public clients tend to be driven by value for money requirements, for transparency, and ensuring the right outcomes for the end users, while private investors tend to focus naturally on things like returns, risk management, and ensuring disciplined reporting. But I think in both cases, it comes down to the same thing, which is setting out clear incentives being transparent about who carries which risks and tracking the performance against measurable outcomes, such as the levels of availability of the infrastructure asset, the cost, the safety, and indeed the ESG characteristics. And that's how we build long-term trust between both public and private clients.
Yeah, it's interesting you say it, because I've just come back from Toronto, the Transforming Infrastructure Performance Summit there. And there was a lot of discussion around Canada's approach to private investment alongside public investment. And this issue of having the data to demonstrate what you're doing, to measure what you're doing, was so important. And the use of digitalisation and data analytics was seen by the Canadians as being really vital. How do you see it? Is that something which is top of your list of stuff that it makes it all work for you at Amber?
Yes, I mean, digitalization and data analytics are definitely something that's becoming increasingly important. And we see the advantages it can bring to things like contract management, understanding the financial performance and the operational performance of underlying investments. At Amber, we use a dedicated system that helps us manage our portfolio, including document management tools that track our contractual obligations, platforms that monitor the audit and inspection requirements, and indeed the life cycle costs that allow us to benchmark across all our assets. And that really gives us a better view and clear visibility, helping us to spot trends and address those early on. And alongside this, Amber is developing new capabilities in data and research, using in-house software to extract and centralize valuation data, and applying even large language models to automate some of that initial analysis and sector research. And I think these innovations really will strengthen the quality and the consistency of decision-making across our portfolio.
I was assuming, Jamie, you were going to get some artificial intelligence in there at some point, but I'm sure that you're also making sure there's a lot of human intelligence that goes in there. Let's talk a bit about you, Jamie. You've been with Amber since 2009, Senior Investment Director. What's the most challenging part of your role? What keeps you motivated in such a complex and fast-moving investment environment?
So I guess the most challenging part is also what makes the role most rewarding, and balancing the long-term nature of infrastructure investments alongside what feels like fast-changing market conditions. I mean, the role means you're constantly managing complexity and trying to align everything from government policy, investor expectations, the regulations, while still trying to deliver the asset on the ground. But I guess what keeps me motivated is seeing the tangible impact that these assets have. These aren't abstract investments. They're assets that keep societies running, from energy security to public transport. And knowing that our work contributes to that purpose makes that complexity worthwhile.
Yeah. Well, before Amber, you were with Amy Ventures and Babcock. I mean, how has this infrastructure investment market changed over the last couple of decades that you've been involved?
So, I would say it's matured enormously. 2 decades ago, infrastructure finance was somewhat of a nascent sector with a focus on single projects, perhaps under things like the PFI model. Whereas today, infrastructure is very much recognised as an asset class in its own right.
It's a point that Charlotte Madden was making a couple of weeks ago on the podcast. It's now a mainstream asset class. It's no longer niche.
Absolutely. And I think with that, it attracts broader capital and also helps ensure that when that capital is invested, it is done so in a much more efficient way. And that ultimately delivers better value for money for end users and consumers. Yeah,
it sounds, Jamie, like we're getting better at it, maybe.
I certainly think so. I think look, these are complex and challenging projects, and it is often well highlighted when they go wrong. But we should also recognise when the projects are delivered well, and projects like Tideway are a great example of that.
Yeah. It's interesting to read that you were an Army reservist for 4 years, from 2009 to 2013, I think. What interested you in that, and why did you stop?
So, yes, I really enjoyed being an Army reservist. At university, I seriously considered a career in the armed forces, but what I opted for was trying to make the best of both worlds. So started a job in the city whilst becoming an Army reservist with the Honourable Artillery Company, or HAC, which is an Army reservist unit based in the heart of the city. And
just near Old Street, yeah.
Yeah, that's right. Hugely rewarding kind of activity and involvement. Something that provided a real differentiator from the desk job, learning new skills and challenging myself both mentally and physically away from the spreadsheets. So really, really enjoyable. Unfortunately, it is something that is quite time consuming alongside a job that is also quite time consuming. Yeah. So it did come to an end, but I've left with a lot of great memories and some great friends.
So what do you do now to unwind? Do you just go voluntarily and just run across the moors with large backpacks on just for fun nowadays? Now, what do you do? What do you do to unwind?
It's a little less intensive than that now, Anthony. But I mean, look, I think something that lots of people can relate to. I have a young family now. A lot of the free time that I have outside of work will naturally, therefore, revolve around them.
How old are you kids?
9 and 7. So a really nice age, actually. I think I've got colleagues who have got teenagers, and I've heard some of the challenges there. And I've got colleagues that with younger kids who are a bit more sleep deprived, and I recall those days, but fortunately don't have to deal with them quite so much. So the kids certainly take up a reasonable amount of my time, but also I enjoy just walking the dog and just trying to find a balance and switching off from what can be at times quite a high intensity role.
Before we move on, I have to ask you, what sort of dog?
He's so Kenny is an Australian cobber dog.
An Australian cobber dog. I've never heard of that one.
Yes, they're not that common actually. But my wife's Australian, and she was convinced she wanted a dog that had some link back to Australia. So that's what we got, and he's lovely.
Okay, well, I'll look that up and maybe put a link to an Australian cobber dog in the notes. Anyway. Back to infrastructure. Private finance is expected to cover, around 60% of the UK's infrastructure pipeline. The models, as we've reflected on it, they have evolved since the early days. PFI in the late 90s has become something of a tarnished brand. We have discussed, rightly or wrongly. What lessons should the UK apply from both successes and failures from previous frameworks?
Yeah, so I think it is worth highlighting that, as you say, whilst PFI has become a bit of a tarnished brand, there were also equally successes. But also what we have learned as an industry is how we can take some of those challenges and evolve the model so that we better align the interests of all the stakeholders. And I think some of the more recent public-private partnership models have managed to achieve that by bringing in mechanisms to allow for change, which maybe some of the older contracts didn't allow for. Things like benchmarking, which also allow for the right kind of cost risk sharing between both public and private stakeholders, and things like refinancing gains that need to be shared. So I think all these features that have helped the model evolve do create better outcomes. And so I think it's important we do highlight that we have got better at this sort of stuff.
Yeah, I think, as you say, a lot of the early deals, they were bad deals, and those lessons have been learnt, and things such as actually being able to change as you go through a project's life cycle is an important part. And we've talked about the RAB model, which underpins Sizewell C, and of course has been very successful on Tideway. But how do you assess whether a project is best suited to a RAB or a PPP or a concession approach? What are the key determinants about what makes each of these different models successful?
So it's usually the procuring authority that selects the model, but it's great when they allow private investors before then to feed in and provide our thoughts. And I think that one of the key points of using the RAB model and the key advantages is when it is applied to projects with particularly long construction periods and particularly complex construction projects. Because the RAB model creates a better risk-sharing framework. It creates an income during the construction from those bills. And that means that it is much better suited to attract lower risk and crucially lower costs of capital to finance these kind of projects. Conversely, availability-based projects tend to only start earning a revenue once they are operational. So to attract low cost of capital investment, those construction periods tend to be shorter and work better for social infrastructure projects where they tend to be schools, healthcare facilities, which have a much shorter construction period.
Because they can get to the revenue generating element of the project or the program that much quicker and with that much more certainty. One of the issues which we constantly hear, though, is that that's driving or really affecting risk is policy consistency and policy confidence coming out of government. And I suppose as we look forward, Jamie, the government's 10-year infrastructure strategy, it's out there. It's got a large pipeline attached to it. And I suppose we can discuss whether or not it's realistic, given the fiscal constraints and delivery capacity going on right now. But are there things in your mind that need to change in terms of policy or procurement that will accelerate this private investment into those critical infrastructure areas?
So as investors in the sector, we are very much encouraged by the government's messaging so far in terms of its ambitions to create an environment to promote partnership and attract private sector capital into these essential infrastructure projects. Looking forward, we hope that policymakers can strive to take a more long-term view on the development of these projects and look beyond the political cycles to give investors the predictability that we need to plan and commit capital over the long term. And I think this includes greater use of these proven models like the regulated asset-based framework, which offer these long-term inflation-linked returns, which also at the same time protect consumers and the public investment. And, where possible, streamlining the procurement process, albeit that does have its own challenges.
Well, and within that, the planning system, I imagine, as well, which goes behind that. Yeah. Well, looking ahead at the Sizewell C project, you've got quite a lot of money attached to that project. What does success look like for you in the next 5 to 10 years on that particular project then?
I think it is investing the capital and managing that closely, that we ensure that we stick as close as possible to the management base case. It is great that we are involved, and I think we've got a lot to offer the project given our past experience in bringing the Tideway project through construction. And we very much aim to deliver something very similar for Sizewell. Tideway has been recently in the press, in the news, because it has reached construction completion. It's been touted as, rightly so, a very positive project for the country, that we can deliver a project in line with its original funding envelope. And I hope that come the end of the construction period for Sizewell, we can be very much saying the same message. And we're working very hard with our other co-shareholders, with government, and of course with the Sizewell management team to ensure that is delivered.
Yeah, well, rest assured, Jamie, I will be keeping a close eye on, but I imagine quite a few other people will also be keeping quite a close eye on what happens at Sizewell C over the next few years. So look, really interesting project, really interesting landscape you're operating in here, and thanks so much for sharing your thoughts with us today on the Infrastructure Podcast.
Thank you very much, Anthony.
Great. Look, Jamie, thanks so much for joining me. As I say, it's all we've got time for, though, sadly, on the podcast today. There is more in the pipeline for the Infrastructure Podcast and more guests to talk to as we continue to probe the big issues faced across this sector. And if you haven't done so already, do check out the Infrastructure Podcast website, www.infrastructure-podcast.com, where you'll find background information background information, including information on Jamie's dog, but all the latest podcasts to listen to and to share with your colleagues. So thanks for joining us. Thanks again to Jamie. I look forward to seeing you again very soon.